Got to talk about retail today. Target shares soaring on the heels of better than expected third quarter earnings. While investors are cheering the overall news, same-store sales were down by nearly 5% compared to a year ago. Joining us now, Michael Lasser, UBS U.S. Hardline, Broadline, and food retail analyst. Michael, it's great to see you.
Great to see you, Julie.
You know, you got to do a double take when you see a reaction like this in the shares. I was looking at the short interest. Is this some kind of short squeeze? I mean, what do you make of a 17.5% gain in Target shares? What does that tell you about what expectations were like going into this?
Yeah, obviously, it says that expectations were low coming into this event. And now what we're seeing from Target is that it can manage its profitability even in an environment where its sales under pressure. And so the market is saying, just think about what Target can do once its sales turn. And that's driving the reaction that you're seeing in the stock today.
And so, Michael, let's talk about those sales, though. So comparable sales did fall about 5%. When does that turn? What does the trajectory look like to you?
So, Josh, what's happening with Target sales right now is two things. One, we all bought coffee makers and vacuum cleaners and televisions during the course of the pandemic. And so it's giving some of that excess demand back. At the same time, Target had a lot of excess inventory in 2022. And so it was aggressively liquidating by discounting that excess inventory. So as those two factors become less of a headwind to Target's total sales, its sales are going to stabilize. The long-term story for Target has been that it's a share gainer, and largely a share gainer at the expense of the retailers that have gone away, the Circuit Cities, the Toys R Us, the Bed Bath & Beyond of the world. And that evolution, that Darwinism of retail is only just going to continue.
You know, it's interesting, though, Michael. The stuff you're referring to is sort of what we call hard lines, right? The coffee makers and such. What about soft lines? What about the apparel, for example? What about those discretionary purchases that maybe aren't being made now? And maybe if the economy continues to weaken, maybe they won't be made for a while.
So if the economy does weaken, you're absolutely right. There will be an impact on the discretionary categories. Another way to think about it, though, is if it's tough for Target, as we move into next year, it's going to be tough for a lot of other retailers like those that occupy a shopping mall or other retail subsectors. So in an environment where consumers need to be more value conscious, I would guess that they're going to consolidate trips, especially consolidate trips at retailers where they can buy several different categories. Plus, Target's likely to see a trade down benefit. So they'll benefit from trip consolidation, trade down, and some normalization of these categories that had been inflated for the last couple of years.
And Michael, you know, another big topic, not just for Target, but for retailers, was this issue of shrink, retail theft. How much of an issue is that still for Target now and looking ahead, Michael? And can we quantify the impact?
So what Target said this quarter is that shrink was a 40 basis point drag year over year. What they also noted is that they expect shrink to be less of a drag, in fact, flat year over year in the fourth quarter. That's just as much about the company taking a big hit from shrink in the fourth quarter of last year as it is a sign that it's starting to normalize. But what we've seen historically is that shrink is cyclical. And shrink has been a massive issue across retail for a multitude of reasons, not only because of organized retail crime, but also because of the new fulfillment methods like Drive Up that these retailers have rolled out in the last few years, plus all of the excessive amount of inventory that's been moving through the retail sector. I would think as we move into next year that shrink is going to be less of an issue. And if that's the case, Josh, Target has the most to benefit from that.
Finally, Michael, before we let you go, of course, the big rival to Target, Walmart, reports tomorrow morning. And in a recent note, you made a really fascinating comparison between Walmart and Apple. Can you just quickly lay that out for us?
So when you look back at Apple in the mid-2000s, it was just beginning on this journey where it was harvesting services, things like the App Store and other things that it was selling to consumers. As that became a larger portion of its total revenue, its multiple expanded. We think there is a very compelling parallel to Walmart at this point. It is early in its life cycle of harvesting high margin revenue streams, like selling advertisements to third-party sellers on its marketplace, to selling its data to a variety of vendors or logistics services. As those revenue streams become a larger portion of its total, we think Walmart's multiple will trade at a premium to where it has historically, and investors should look to that as a way to generate alpha from this stock moving forward.
Michael Lasser from UBS. Michael, thank you so much for joining us today. That was great. Appreciate it.